Welcome to the Mainstream Mortgages podcast. My name is Peter Paley, and I'm here with my two business partners, Derek Vandal and Colton
Hello.
Boudreau. And today we are going to talk about down payment, everything you need to know about down payment, what you can use for it, and what we have to do as mortgage professionals. So, down payment is a major part of any mortgage application. In our previous episodes, we talked about pre-approvals, then we talked about income and how we have to verify that. And today I really wanted to dive in to down payment. So the first question I'm going to throw to Derek is what is the minimum amount you can put down when you're purchasing a home?
5% is the minimum. You might see some people say, oh, 0% down. Don't trust them. You need 5% in Canada. Absolute minimum.
And so when someone puts down 5%, that means they have to pay mortgage default insurance. Can you describe what mortgage default insurance is?
Sure. Mortgage default insurance is commonly misinterpreted or misunderstood by borrowers because they hear insurance and they think, oh, it's insurance for me, for my mortgage, right? The truth is that the borrower does not benefit from mortgage default insurance. Default insurance is different from creditor insurance. Okay. So the default insurance covers the lender. If you, the borrower, stop making your mortgage payments, and that means that the mortgage is in default, and the lender has to foreclose on your home, take it over, and then sell it, they might incur some losses because of that. And what mortgage default insurance does for the lender is it basically pays for those losses for them. There is a cost for mortgage default insurance, and believe it or not, the borrower pays that cost when you have less than 20% down. So you're paying the cost, but the lender gets the benefit.
Okay, so Colton, Derek said the minimum down payment's 5%, but that only applies if you're purchasing a house $500,000 or less. What happens if the purchase price is over 500,000?
Yeah, so any purchase price over 500,000, you're putting 10% of that remaining balance upwards to a million there, right? So it's 5% plus 10% on the remaining balance. So if it's 550,000, 10% on that extra 50,000, um, which is something that borrowers don't seem to know either. And why would they? But it's good for us to let them know that up front, right?
Well, 100%. We get that question all the time. Someone wants to buy seven or a $600,000 home and they think they can put down $30,000, which is 5%, but it's not true. You really need 35,000, representing 5% of the first 500, which is 25,000, plus 10% of the balance, which is the extra money to make 35,000. So, Derek, you touched on mortgage default insurance, what it is, what happens, why we need it, and but you mentioned at 20% down, it's not required. So, can you explain that?
Yeah, when you have 20% down payment, you don't necessarily need to pay for the default insurance premium, but the lender is going to probably pay for it behind the scenes. So it's not like the lender's not going to have default insurance on your mortgage. Most of the time, they will pay for it on their behalf.
And why did they do that at 20% down and not
Um,
less than 20% down?
Well, at less than 20% down, you've heard of the default insurer, CMHC. That's one of the three in Canada. The other two are Canada Guarantee and Sagen. So any one of those three insurers may be the default insurer on your mortgage. Now the regulations in Canada are that if you have less than 20% down payment, you need to have that default insurance, and the borrower is the one that pays for it. If you have 20% down or more, then you don't need to pay for that default insurance premium. So that's why I say the lender is probably going to pay for it behind the scenes because now you don't have to.
And the borrow, it doesn't matter to the borrow one way or the other, and you won't know if the lender actually did it or not. So there's no real
Exactly.
main effect to the borrower. But at 20% down, you don't have to pay or include that default insurance premium in your mortgage. So Colton, what else happens at 20% down? So with an insured mortgage or less than 20% down, you get the best rate. But what happens at 20% down or more?
Your rate goes up, right? And it goes up because now the lender is taking on the risk instead of the insurers, right? So with the higher rate, though, you can extend your amortization up to 30 years, even if you aren't a first-time home buyer, right? So that first-time home buyer gig is for insured mortgages where you can go up to 30-year amortization. Whereas if you do the 20% down, you're allowed to go up to the 30-year amortization regardless.
That's great. And now that we've sort of covered off on the down payment amounts, let's get right into it. So big news in the mortgage broker world is we have to track all money being used for your down payment, and we have to do that for 90 days. And that's under federal government regulation, and it's being monitored by an agency called FinTrack. So Derek, you're a compliance officer, and I feel like this is going to be a real major issue for you going forward. Can you tell all our viewers like what we need to do as mortgage brokers to verify that down payment being used?
Absolutely. In Canada, the federal regulation is that each mortgage borrower needs to confirm where their down payment funds are coming from in multiple different ways. But the main way is by providing a 90-day transaction history from the account where those down payment funds are. So let's say you got your savings account, you've got your 30,000 for your down payments, let's say, and it's just sitting in that savings account. Maybe you transfer in, $100, $500 a month to that savings account on a monthly basis, and for the last 90 days, that's all that's in there as far as transaction goes. That's great. However, if you have any larger transactions, generally speaking, larger than 2,000, let's say, then the lender is going to also need 90-day transaction history from where that 2,000 deposit came from. And if there are any large deposits in those 90-day transaction history statements, then yes, you'll need to keep going on and on and on it goes. It can be super frustrating for everyone involved if that ends up being the case. However, there are other requirements. I don't know if you want me to get into the other requirements,
No, it's
Peter.
okay. I'm going to have some follow-up questions. But
Okay.
I'm the old guy on the team. And even today, when I print off my bank statement, it's a one pager. Like it's just one page. Like my mortgage payment, my car insurance, my utility bills, maybe a cash withdrawal here, maybe some Interact purchases at Costco or the grocery store, and that's it. So, Colton, what happens, because you're a young person, when people have multiple accounts and they do a lot of transactions? What do you have to do to confirm the down payment for 3 months?
Oh boy, it can be a real pain. If people have multiple accounts that they're using towards the down payment and closing costs, like Derek kind of mentioned, we have to source every single account if it's being used. So if you have 3 accounts or 4 accounts, we need to see 90 days of all accounts. And if it's a TFSA, an RSP, just even your savings account or checking, 90 days will need to be provided. And if you're moving money in and out of your checking to your savings to your TFSA or whatever the realm might be, we have to source all that, like Derek mentioned. And so if you made a large deposit or e-transfer, sorry, today of 2,500 from your checking to your savings, we would have to get both your checking and your savings account from today, see the money leaving your account, going into your account. And it can just create this real spider's web of e-transfers or deposits and just accounts, right? So there's reasons why people do it, but for the purpose of obtaining a mortgage, we always like the clean accounts, of course.
So, what I'm hearing here as a piece of advice to offer anyone who's watching, for your down payment money, please keep it in one account and keep it in there for 90 days with limited transactions.
Yep.
Yeah, to say the
Yeah.
least.
If wasn't my turn to host, I would ask myself, what was my worst experience with the down payment? Had first time home buyers. Mom and dad gifted them $200,000, which is totally fine. It was husband and a wife. They opened up 5 accounts each. And over the course of that 90 days, they did 74 transfers between 10 accounts. And the reason for them doing this was one, to take advantage of their first time home savings account, also to take advantage of their RSP. And they're also trying to get interest rate bonuses from different banks and different account types. So I had to spend 5 hours going through and mapping each transaction, like all the money was there, deposit here, transfer here, withdrawal from there, transfer there, and it took a long time. So that advice that I gave about keeping it all in one account for 90 days is more of a request. Like, please keep your down payments clean. It's a lot of unnecessary work. And if you do something incorrectly in those transfers, or there's some money we can't source, it could actually void that account from us being able to use it for your down payment. So that's my advice over there. Now let's get into the types of down payment. So clearly savings, um, RSP, tax savings account that you built over time are allowed. But let's throw this to Derek and tell me about gifted down payments, what they are and who can gift the money.
Yeah, so you mentioned in your example there, Peter, that the parents gifted some funds for the down payment. A gifted down payment, generally speaking, needs to be from immediate family member again. So, parent, sibling, or child. The amount of gifted down payment doesn't necessarily matter. If it's a very large gifted down payment, then we're looking at more requirements for the down payment verification. But generally speaking, if it's a regular gift of, $5,000, let's say, for example, then we generally just need a gift letter. And that's basically it. We need to confirm that it was also deposited into the borrower's account. But yeah.
Okay, so Colton, Derek mentioned that it had to be from an immediate family member, but that doesn't always happen. So what exceptions can we request as mortgage brokers for people giving down payment? Like, can a husband or wife or spouse give the down payment? What about uncles, aunties, grandparents? Anything? Let's
Yeah,
just
there are
Yeah,
elaborate on that.
exceptions. Yeah. Go ahead,
yeah,
Colton.
grandparents can definitely gift the money. It's the same sort of concept of was what Derek mentioned: gift letter, deposit into your account. Um, where was I going with this? Oh boy. Um,
Aunties and uncles and spouses.
yeah, they can.
Yeah.
There's always exceptions. Sorry, apologies, I just lost all track. Always exceptions, right? And if we just make the case, right? Like they help them out, or they're close with this family, they're close with, this daughter, whatever it might be. And there's always an exception to the rule as long as it's within the realm and you can clearly explain it. Um, so just being upfront and forward with where that money did come from is really important to us, and then giving that information to the lender, right?
Sure. No, that's a really great explanation. So, there's a common misconception in the industry, like with realtors, borrowers, and even some mortgage professionals at certain financial institutions. What about borrowed funds? It is a real common misconception that you cannot use borrowed funds for your down payment. Derek, can you explain on borrowed down payment programs?
Yeah, borrowed down payment is it's kind of tricky, but it's also pretty simple. Um, the reason why it seems like you can't use borrowed down payment is because whenever a lender's looking at your mortgage application, they're going to look at all of your debts, right? And so if you have a car loan, let's say for example, the payments $450 a month, that's going to reduce the amount that you qualify for, the total mortgage size that you qualify for by about $100,000. So now, if you consider that, you take that concept and you move it towards the gifted down payment idea, the gift, or sorry, not gifted, so the borrowed down payment idea. If you're borrowing your down payment from, for example, a line of credit, now the lender has to take the amount that you're borrowing from that line of credit and calculate it against the amount of mortgage that you can qualify for. So yes, you can borrow down payment for your mortgage. However, you'll qualify for much less of a mortgage if you do, depending on how much you're borrowing.
Great. And then Colton, so we've used this program many, many times in our practice. What else do borrowers need to know about the program? Like, does it cost extra?
It can, right? It really depends the situation, and it depends what you're using. Like Derek mentioned, the line of credit is considered borrowed down payment. Then yes, you would be paying a little extra insurance premium. And also, lenders have tighter guidelines when qualifying for said mortgage because you're borrowing those funds, right? So there might be a little more risk in their opinion as an insurer and as a lender because you don't actually have those funds. So you're borrowing them, right? But there are ways around it, and people can definitely use the program. We've used it. It's all about connecting the dots and putting the application together in a manner where the insurers and the lenders understand and are on board with.
Great. So this next situation I'm going to talk about happens a lot. So the client comes to us, they already own a home, they have a mortgage on that home, and they want to maybe upgrade their home to accommodate their bigger family, but they don't maybe have enough money saved in their savings for a down payment. So how would one go about wanting to sell their existing home and use that equity in their current property to buy their new home? Derek.
Well, the first thing I would say is that they should probably try to have that home sold before they have an accepted offer on a new home, or at least have confidence that the home will be sold before at least 2 weeks before you move into the new home, right? Um, the Did you want me to get into like bridge financing or just
No, I'm going to
yeah,
follow up with
okay.
Colton. Yeah.
Fair enough. Yeah, no, if as long as they sell their home, before they move into the new home, then they can use the sale proceeds towards the down payment on the new home.
Great. So Colton, Derek just gave us the ideal scenario. The people sell their house, they have nowhere to move, and then they go shopping for a house. Like that just isn't reality for a lot of people. You have to be a certain kind of person to do that. Um, when I bought the house I'm living in now, I certainly didn't do that. I didn't just sell my house and then go buy a new house. I did that once in my life. It's a lot of pressure for somebody.
Yeah.
So, what do we do as mortgage brokers when people come to us who have a house to sell and want to buy a new house and no down payment? Like, what can you elaborate on that?
Yeah, so Derek kind of briefly mentioned bridge financing, right? So when people come to us for a mortgage approval, we say subject to the sale of 123 Main Street, their current house, right? And then typically they do go and get an accepted offer on 234 Abbotsford Street, and we meet the conditions on that subject to the sale. So say they're taking possession in a month on the new place, they have to have their old place sold a minimum of 10 business days prior to the new possession. And if they do that, which they should in this market, it's pretty common. Houses are flying off the shelves, it seems. Then we can bridge those funds, however much they need for the down payment, bridge those funds over an extended period of time, which is usually about 30 days, give or take, which allows them to bridge the funds. So the lawyers handle that part of the deal, and then they pay out everything. And if there's any leftover money from the bridge proceeds, then you get that in your pocket.
So, the bridge loan, the bank gives a loan to the clients. when they have a firm sale on their existing house for the amount of equity that they have in there, so they can use it towards the down payment on the new house, correct?
Yep.
Okay, but let's say that didn't happen and they didn't sell their house. What do we need to do as a mortgage professional to account for the worst case scenario where their house doesn't sell?
Yeah. So if their house doesn't sell, and we do this a lot, right? We're worst case scenario thinkers. By trade. It
Yeah,
sucks to think like that, but
occupational hazard.
yeah,
Yeah,
it stresses out more than it should, right? But it's good to have a backup plan essentially if your house doesn't sell. And if your house doesn't sell, then we can do something like converting it to a rental, where now this your current house is now a rental, so we can use that rental income for your application. And then we kind of try to piece together your what we need or how to get your down payment, right? Is it gifted from a family member? Do you have a line of credit we can maybe use, right? Or maybe you have some funds, whether it's a TVC or an ISP saved up that you can do, and then it gets paid out when you do sell your house, right? There's a couple different scenarios we can go to, but it's all about just mapping that out prematurely, really. And chances are it's not going to happen, but we like to think, like I said, worst case scenario, just in case it does not.
that's like so great. So it really ties in back to our first two episodes about getting the pre-approval and coming to us first to make sure we explore all options. Because if you go out and offer on a home willy-nilly, like you have no idea if you can even get approved for it.
Right.
So just in the interest of time, because you guys always do 25-minute episodes and I seem to go a little bit over, I'm going to wrap up this session today. But what else? What's the one piece of advice that each of you would give to prospective home buyers about the down payment? Derek.
Um, I don't have a really one piece. Colton, do you want to go first? Maybe I can think about it a little bit longer.
Sure. So I would say the most important part of down payment is keeping your accounts clean. We kind of mentioned that earlier, right? No large deposits. If you're selling something like a car, a boat, or anything in that realm, please get a bill of sale. Super important. And if you're selling on Facebook Marketplace, those little e-transfers, if those add up, those don't look good to a lender. So again, it comes back to keeping your statements clean. If you're doing stuff on the side, maybe have a different account for that information or those deposits, right? And then, like for myself, I have a savings account that I do not touch. So if I needed to buy a new home, it's clean, it's easy to use. Just print that off. Whereas my checking statement or whatever other statement might be, it's a little messier, but I don't got to worry about that statement now because I know I've got money saved up in this account. And I would also say just start saving, even little bit by little bit. It adds up, right? And it's super important to understand that. And it's what I tell our home buyers, honestly.
Yeah, the
Derek,
last
did you
thing I
come
would
up with some?
I didn't really come up with like one tip. I mean, Colton touched on the main things that people need to think about, I think. And tying into all of that, from what I heard, is if you're not sure, talk to your mortgage broker and say, okay, what should I do? I have this, or I plan on getting money from here or from there. How should I structure it so that I'm ready when I do buy a home? And we also didn't really touch on, I don't want to get into too much detail because we got to wrap it up, but we didn't touch on, gifted funds from overseas, or even if it's your own funds from a different country. If you have funds coming from a different country, that's another thing to talk to your mortgage broker about. So I would say the best piece of advice is always talk to your mortgage broker and before you do anything, really.
That's always the best piece of advice.
Yeah.
So just before we sign off here, I just want to go over it again. We talked about minimum down payments and maximum down payments, or like making it between insured and conventional, and um, some of the details around that. What we have to do as mortgage professionals to verify every cent being used for down payment and closing costs, and also the different types of down payments that are maybe non-traditional that we are able to use as mortgage brokers. So I wanted to thank everyone for listening today, and of course, thank you to Derek and Colton for providing that excellent advice. And stay tuned, like and follow Mainstream Mortgages podcast for our next episode, which will be coming out next week. Thank you, everybody.
Always a pleasure.
Thank you.